When we talk about option trading, a question comes in our mind that, ma'am, which strategy to follow? Today we are going to learn which strategy I use from which I'm getting regular profit. So I hope this video will be very valuable for you. Look, first of all, if you are thinking by any chance that I'll tell you very complicated strategy, I won't. I tell you the strategy that I use, and you too will be able to use it very comfortably. And these are the strategies that your broker or the people who work in option don't want you to know. Because it is so simple. If I will get to earn money in simple way, why will I work in 5, 6, 7, 10 call put? I will not. So we are going to talk about very simple strategies. I'm assuming this that first you have watched our first two videos. First video was basics. What is option? What is call? What is put? Second was should you do put selling, call selling, option selling, or buying? You must have got the links of both these videos in the I buttons. Check them out. Today we will talk about top 3 strategies. By the way, these basics will become clear to us after strategies. If you genuinely want to know what strategy the broker wants you to do and pushes you to do, if you want to know this too, then tell me by commenting, and if needed, we will try to talk about it too. So, let's move towards first and very simple strategy, covered call. Here you have to sell something. What to sell? As mentioned in the name, call. Selling a call by covering. From which will you cover it? From your portfolio. That means first you will buy a stock. Suppose there is XYZ. According to my personal strategies, according to technical, suppose XYZ is moving around 2400 and here's signaling to buy and I want to buy it here. My target can be 2500, 2600, whatever it can be. Suppose our target is 2500. We have bought in 2400, 2500 is my target. What I have to do? Wait. But why wait when you can earn something? In this time, you can sell 2500 call for $40. That will be your income. When the stock will go to 2600, you will sell it anyway. But by chance it won't reach there in a month, then at least you will have an income of $40. Do you have to worry? No, because you already have stock. You already have the stock to reduce its cost to earn something additional income. You sold call covering it. When you sold call, your actual net cost has become $23.60 without doing anything. This is called very simple covers strategy. I would like to tell you one more thing in this strategy that if you sell, look carefully here, XYZ is moving around 2400 and our target is that it will go up to 2500. But even if it didn't go to 2500, you can already start earning money by selling. If you are selling 2500 option, which is out of the money option, and here you already know that there is work in lots. Now, if there is lot of 2500 according to $40, you get $10,000. You want to earn this $10,000, then you can use this strategy. This is an example of XYZ. You can use it in any stock, rather you can do it in the index as well. Suppose the market is moving around 16,000 in S&P 500 and I have to book profit of my portfolio, which can be mutual fund or index fund portfolio when S&P 500 will reach 18,000. I have this mindset. So, will you keep on selling S&P 500 call of 80,000? Until it goes, you can get some additional income. And anyway, when it goes to 80,000, you have to sell it. So, sell it comfortably. At that time, also your premium, almost because of time value of money, which is your biggest best friend, this would have given you a good profit in this complete option selling. Now let's talk about what are the positives and the negatives of this strategy. I will also tell you the negatives and I will give you its solution as well. Very first positive. Why wait when you can earn some extra? Have portfolio, have stocks, why wait? Let us do some call selling and start earning some extra. Secondly, there is no additional risk. You are buying the stock anyway, you also have portfolio, you are just hedging it while selling the call. It is going to be so simple for you. Now, what are negatives? Trade if our stock, which was 2400 of XYZ, gives breakout. So guys, even if you were not selling call, even then it would Okay. That you would have lost. Just like you maintained a stop loss, you have to do that here as well. You just understand it that your cost is 2360 instead of 2400. At least you will get less losses. Second, very limited upside. Who knows if XYZ would reach 3000? Hey sir, you sold a call. What was your target? If it would reach 3000, then you would get out of this 99%. So if you had to get out, then remove such mental block from your mind and understand what we are trying to do in this strategy. When do you have to exit in this strategy? The level at which you sold call. If the price was 2400 of the stock and I have sold call of 2500, when the stock price reaches 2500, I will book my profit in my stock and close the call at whatever price is going on at the same time, which is best risk reward ratio for you. You will get net to net profit. You will get very good profit. And usually, even if a little time has passed in this, then your call premium will also have come down. That you will also have, you also get a little money in your pocket from the pocket of the call buyer. And second, the profit that the stock increased easily become your profit. First strategy is over. You will say that make it complicated can make it complicated. Generally, if you say then I will tell you the complicated strategy. You will say bravo Traddy, enjoy listening, but you will not be able to apply it. Now let's move on to second strategy. Name is put selling, and I would like to tell you one thing that the strategy you are listening, maybe this is the first time for you, then you can listen this video many times, which will give you clarity. If you want to understand at once, then make notes. You can also do paper trade before trading, then you can see how much profit you are getting, how much fun it is, and then you can take advantage of these strategy. And anyway, you are getting the entire series for free on my channel. There are no restrictions that you have to watch in a single day or after a day you can't revise. It's available on YouTube for free. Take advantage of it. Now let's go over the second strategy. Name is put selling. What happens many times? The price of XYZ is moving around 2400. I want to buy XYZ in 2300. I'm waiting for 2400 to come. Or suppose S&P 500 is moving around 14,000. I want to make my portfolio, but I will make it at the time when I will get 14,000 price of S&P 500. I want to buy in index. How many times it happens that the price doesn't come, but we just get stuck in waiting game, and it becomes the fear of missing out, that I missed out. So why wait when you can use put selling strategy? XYZ price is moving around 2400. I have to buy at 2300, so I will keep selling the put easily of 2300. Right to sell, I have sold at 2300. So until my stock reach at 2300, my premium will continue to be decay. I will keep on waiting. If it reaches 2300 or below 2300, then nothing. As soon as it reaches 2300, which case you already have in bank account or in demat account, you have to buy a stock from that case, or the put you have covered, you have to sell that. You will also be able to buy at which price you want to buy, and as long as you are not able to buy, you keep getting regular income. Positives, regular income. By chance, the price you wanted it to be reached, it didn't reach in this month. So the premium you got for the month of $40 is already in your pocket. And even if it didn't reach in next month's $40 you got in your pocket. Regular income. And second, you can build your lovely stock, your lovely portfolio at desired level. What are negatives? Traddy, we sold put at 2300. Now what happens if the stock keeps falling? Then nothing, sir. If you sold put of 2300, that was the price at which you wanted to buy. So I assume when the price would have come to 2300, then you have bought the stock and you are making loss in put. It's same thing. It's a game of mind. Change your mind a little bit. It will be easy for you. And if your stop loss gets hit, then you can also exit taking a little loss, which we are going to cover in next slide. Risk management. How to manage risk. You don't need that you have to buy every time. If you have money available, then the first option is to buy the stock. Otherwise, it has a simple stop loss only. Suppose you have got loss of premium of $40. By selling, it turns out to be 200%. You cover it. Don't worry. Our mistake is that we got lost. Winning probability is decided. Winning probability is with you when you trade. And you trade by applying technicals, understanding the proper framework. Even if you hit the stop loss, then you will get the exit by applying the rule of 200%. It means that if you were making profit here, then if you lost $40, then you went to minus $40. So get out as soon as you get loss of minus $40. When we have come to know that we have fallen in a hole, then do not dig that hole more. Don't dig means that if you are getting lost, don't wait that I will get profit because you have 70% flash chances in your selling anyway. I'm not saying it is saying probability. Math is saying that your probability of winning is 80%. There is an 80% chance that your trade will be successful if you trade a little carefully. The biggest problem or the biggest loophole of the first two strategies so far was there, as I said before this video, that you require margin. You need sufficient margin. If your capital is too low, then you may not be able to use this strategy. But we have a solution for that. We have third strategy. There should be at least one strategy in option selling where the margin is also required less and our peace of mind also remains. Its name is vertical credit. Vertical credit has two parts: bull put spread, bear call spread. The name itself will tell you what you are going to do. Bull means you will accelerate in this particular stock. Put means you will accelerate using put. Spread means that you will also buy, you will also sell. You are going to make two different transactions at the same time. Bear call spread. Bear means you will slow down. Call means you will slow down using call. Spread means you will also buy, you will sell. Two different transactions are going to be in a strategy. Same example XYZ because one example needs to be continued throughout the entire series. 2400 is the price. I feel that XYZ will increase here. The market is also in uptrend. Everything is my favor. So very first leg of transaction happens for us that we have sold put of 2300. Got $40. So it is the same thing we did in the previous strategy that we sold naked put, but selling naked put almost. As we talk about this example, then you are going to require a margin of $20,000. If you want to decrease it, then we'll continue its second leg. In the first leg, we sold the put out of the money. In the second leg, we bought put for the out of the money. We bought at 2200 instead of 2300. Obviously, the premium will be less because we have bought further out of the money. And this is your bull put spread. Maximum gain $30. Difference between these two and what max loss will be in this scenario. Now you tell me by commenting. If needed, pause the video. I'm waiting for your answer. Tell me what is the correct answer by commenting. I hope you have answered. Actually, answer is loss of $70. How? The price fell $100 here. I have lost $100 and I have got net premium of $30. So my net loss is $70. If my price goes below 2200, if major crash happens in my stock, you may feel like I just said the risk-reward ratio is bad, but here you have got the cushioning. Your probability of success are on your side. 1:2. On the negative side, you will have to take risk to reward. Then only this strategy will work. I give you a hint. By this you will understand as soon as we make the bull call spread. Our net will not inflow. You will have to give net outflow. From day one, you are in loss. It is compulsory. You will start option buying and our strategy is option selling. But there in the first day, you have paid some premium and we talked about in our old video, if you have paid premium, the probability of success is not on your side. Here you may have a risk to reward ratio of 1:2 or 1:3 on the reverse side, but your probability of success is on your side. Plus, you think 2400 price is going on, you are bullish as well. Only here you will give money. If you are realistically wrong, the stock price is 2400, now it is 2000, then at that time obviously we have to pay some cost. That too is limited for us because we have covered against this. If we talk about bear call spread, and it's just opposite of that. Here we are playing bearish. The vision is that the market will be bearish. But we are trading in call option instead of put option. So amazing because most people don't do this. So if you put bear put spread in it, then you will have to give net outflow. You try it, you will understand it easily. In this strategy, I think you have got it. So 2400 price is going on. We have sold the call of 2500 out of the money. 2600 I have bought further out of the money. Net of my premium of $30 has been paid, which is inflow. Risk to reward ratio is exactly same. Until the stock price go drastically up or reach up to 2600, I will not lose. Suppose it reaches 2500, I'm in profit. I'm in profit in a 2510. I'm in profit in a 2520. No profit, no loss in 2540. My loss will start above that. I mean after 2540. Finally, the positives and negative of this strategy. If you have not liked it, then like it. If you haven't subscribed yet, then subscribe it because this is just one content. You get amazing content on this channel, so you should always get it. Positives, limited loss. When we talk about risk management, is already built in the strategy. On the first day, you know how much is your risk and how much your reward. You can sit and pace. Here do not need to see the market again and again. Once this strategy is made, I leave the market for the whole month. The risk reward ratio will take care itself. And here the next important point comes. What happens many times? Your stock will go against you. Suppose you made a bear call spread, the stock price went up to 2700. But you are still in the game. Your loss is as high as it should have been. It may be possible that it has gone up there during the month, but it will be retested so that you are still in the game. Since your stop loss is already decided, so you are not exiting the game. You are not out of the market. You knew what the loss was from first day, but still by chance it reversed without doing anything. Here we are not doing voting game. We have set our stop loss by default from the first day, but you are still waiting. And finally, what can be a good way to earn regular income? You can earn good money by doing regular bull put spread or bear call spread. Negatives. It's a boring strategy. If you want to wake up in the morning to do some work, if I don't make a deal, I won't be able to take a spin of my morning coffee. Then this strategy is not for you. If you can't wait, if you want that I did option selling today, I will get profit tomorrow, then it will not happen. This strategy is a boring strategy. You have to wait whole month because I'm assuming that you have work in the monthly expiry. You have to wait for the whole month. Only then you will get profit. And finally, a little care has to be taken that you get liquidity at the strike price you are working on. Anytime if you do not get liquidity, the problem arises. It also depends on the stock, which stock you have picked. It is only matter of stock selection. You will have to choose such a stock where you can sufficiently get liquidity at different strike price. I hope you found this complete series very useful. Happy learning, and I will see you very soon.